You mentioned tariffs. I think this is a disastrous policy. I'm completely against all sanctions and all tariffs, by the way. I'm a free trade unilateralist. So the obsession that Trump has is with the trade deficit. He wants to eliminate the trade deficit. He's a mercantilist, and he thinks the trade deficit is caused by nefarious activities of foreigners, foreign subsidies, foreign tariffs, and he wants to close the deficit. And he thinks tariffs will do it. No, tariffs won't. The trade deficit is made in the USA. The U.S. has a savings deficiency. That means savings is less than investment. Most of that savings deficiency is caused by the federal government's deficits. That's where the deficiency comes from. And as a result, we have had 25 years of trade deficits, but they've been caused by the fiscal deficit and the savings deficiency that exist in the United States. So how do you fill the deficiency? You fill it by importing, because we can finance the imports without a problem. So if Trump really understood this savings investment identity in economics and what causes trade deficits and trade surpluses, he would just balance the federal budget and the trade deficit would go away. Let me reverse it. We have a savings surplus in China because they have a savings surplus. Japan has a trade surplus because they have a savings surplus. Switzerland always runs a trade surplus because they save a lot. Same with Germany. Now, if the U.S. puts tariffs on, that will simply mean it won't change the overall deficit. That is given by the savings, investment, and identity and the deficiency we have in savings. The tariffs will just move who is filling that deficit around. So instead of getting so much in terms of goods and services from China, we'll get more from Indonesia and Vietnam and other places. And by the way, when you run the numbers, which I've done, it means that between about 5.5% and 27%, that's a big range, but still, if that will be the cost for household income, it'll be minus 5.5 to minus 27. Something in that big range will make Americans poorer. Tariffs make Americans poorer. The people that are going to Walmart and buying imported goods from China, people going to the grocery store and buying bananas from Ecuador and avocados from Mexico, they're losing. Most people don't realize American exporters will be big losers because the exporters actually import a lot of inputs they use to make whatever they're exporting. And those things will increase in cost and the exporters will be damaged. The one other big thing, Trump is a mercantilist. And of course that was popular in the 16th to the 18th century. They thought if you were running a trade surplus, that was good, and if you were running a deficit, that was bad. And most businessmen, by the way, have this mercantilist idea because they think a country is analogous to a business. And with a business, of course, you want to be selling more and bringing in more revenue than the cost going out. You don't want to run a deficit because if you do, you'll go bankrupt. A good idea that he has is to reestablish sovereignty in the United States and control a border. He's got this Elon Musk in there with what they call Doge, and he's shutting down USAID, which has been a corrupt operation since day one. Now, the larger geopolitical things, and the thing that's most interesting for Europe directly, is he wants to shut the war down in Ukraine. It looks like he's going to start negotiating with Putin on this, and the Russian position is very clear. Number one, objectively, the war has been already won by Russia. They occupy the 4 big Donbass regions, and that Crimea is retained by Russia, and that Ukraine never goes in NATO. Those are the basic demands, and Putin won't move on those. And it looks like, given the signals that are coming out of Trump White House, that Trump's going to more or less go along with those, and the war will come to an end. Europe is lagging behind and has been certainly since the great financial crisis in 2008. I've looked at the per capita GDP growth in the U.S. and compared it to the EU, and the EU is lagging way, way behind. And it's getting worse. Added to that, of course, you have the aggravation of the war in Ukraine and the fact that no Russian gas. So that Europe, very negative. And what I see coming this year is going to be a great deal of fiscal and political chaos, because President Trump has indicated that he wants the NATO members to increase their defense expenditures up to 5% of GDP. And the European countries, they just can't afford it. They don't have the money. So this is going to create a tremendous amount of tension, I think. France is in a fiscal mess right now. Germany is in a complete fiscal mess. They're even debating in Germany about getting rid of the German debt brake. And you have an election coming up in Germany later this month. So we'll see how that develops. So a lot of political instability, a lot of fiscal problems, and a background of low productivity growth, way too many regulations. That's Europe. The United States, I anticipate, by most measures, the biggest economy in the world, not on a purchasing power parity basis. China's bigger than the United States, but the U.S., I think, will slow down this year. And the reason for that is that the money supply has actually contracted and is a little smaller than it was in the summer of 2022. So with that, usually what happens, we've only had 4 times in the U.S. where the money supply has contracted, and what happened? We always had a recession. Or in one of the 4 cases, 1929 to 1933, we had Great Depression. So I anticipate that based on the quantity theory of money, because that is the most reliable model to forecast and indicate where the course of nominal GDP is going. I think it's going to be slowing. I don't think it will end it, because what happened, you explained the acceleration. When the balance sheet went up and the money supply actually peaked out, it was growing. After the COVID pandemic, they accelerated tremendously. And the money supply was growing at a peak at 17% year over year. That's the highest rate the money supply, measured by M2, has ever grown in the United States. That is about 3 times higher than Hanke's golden growth rate of 6%, a rate consistent with hitting the 2% inflation target. We went way over the inflation target, and John Greenwood and I predicted that we would go up to at least 9% inflation. We peaked out at 9.1%, and then the Fed reversed things and put on the brakes, started shrink. We went into quantitative tightening and start shrinking the balance sheet, and that's a contraction that I was talking about. So we're a roller coaster, up, down, up, down. And why do I think that will continue? Because the Fed ignores the quantity theory of money. The chairman of the Federal Reserve, Jerome Powell, has testified many times that the Fed believes that there's no reliable connection between changes in the money supply and changes in real economic activity. So if you ignore the money supply, the game is over. So that's the U.S. China, the second or the first biggest economy in the world, is in trouble. Again, based on the quantity theory of money, the money supply should be growing at about 11% per year if China was hitting its inflation target of 3%. Well, it's growing at about 7% only. And that's why, what is the inflation in China? It's not 3%, it's 0. So China, they're feeling the pain of the housing crisis and real estate crisis, which is causing the private sector in China to deleverage. And at the same time, normally, if the private sector is deleveraging, what happens? You usually get more leverage coming in the public sector, but that's not happening in China. So I think China will stay slow. So the picture doesn't really look that great. You ask a question, well, what's my view of where interest rates are going? To find that out, you just go to the federal funds futures market in the Chicago Mercantile Exchange, and you see objectively what people who are in the market with money in the skin in the game, as they say, what they think. And it looks like they think the next 2 Fed meetings, there'll be no change. And in the 3rd meeting, they think there's less than 50% chance that they'll reduce the Fed funds rates by 25 basis points. So the market is basically agreeing with the chairman of the Bank of America. I just look at the market and you have the exact probabilities, and that's it. If you look at the U.S. stock market, which of course in the international indices, it takes up about 70% or more, all the equities in the world. So the elephant in the room is New York. And what you have in terms of valuations, any way you want to value it, and I have my own bubble detector, and the stock market is in the bubble zone right now. But all these metrics and measures for bubbles indicate that it's overpriced, overvalued, and overhyped. So it's always very difficult to predict when a bubble is going to pop. Bitcoin is almost by definition in a bubble. It has no fundamental value. It just has speculative value. You never know what's going to happen. And then we've got these wars going on. We mentioned Ukraine. You've got the Middle East and the threat against China by the U.S. to go to war. If nothing else, there's a trade war. And my view is that if you're in risk assets, you're investing dangerously with all these things. And I think investors are just too complacent. None of these things are priced into the market. The bubble detector, obviously that isn't priced in. The Bitcoin thing isn't priced in. You actually have governments now. The central bank governor in the Czech Republic has said that he's thinking about investing in Bitcoin. Or in the United States, the new head of the U.S. Treasury is talking about setting up a sovereign wealth fund that will invest in Bitcoin. So you know you're in trouble when you get officials starting to talk like that.